Hello guys. So in this video, I just quickly want to go over a topic that might seem like very complicated for some people to really believe, or for some people to understand, right? Some people will refuse to believe what I'm about to say, right? But something a lot of people should know is that smart money trading could be holding you back. Trading in a way where you're looking for like a 10 pip stop loss or a 20 pip stop loss could actually be the reason why you're inconsistent, right? And I'm going to break it down and just try to explain to you what I mean, all right? So let's get into the video and let's get into explaining what I mean. So I have two diagrams basically here, right? Those of you trading smart money, you obviously recognize this, right? You would obviously recognize this. So this is a kind of entry. Let's take this as our exhibit A, right? So let's say it's exhibit A. So in smart money trading, or the idea of smart money trading, right, is you're trying to figure out how to get a drawdown with an entry with zero drawdown, right? So you're looking for how you can get entries with no drawdown, sniper entries, right? This is what they're called in the markets today. A lot of people are calling sniper entries. And it's very funny to think that you would think that a trade, just because you got a trade or an entry with zero drawdown, it doesn't mean you've even gotten the trade right? The most important thing in the market is being able to predict the direction of a market. Is it going to be bullish? Is it going to be bearish, right? And a lot of the times, a lot of people are more focused on how to get sniper entry than being correct or being right about calling the direction of the market. And the direction of the market, or getting the direction of the market right, is actually very important. It's more important than getting a sniper entry, because at the end of the day, what you want is consistent returns, and consistent returns come from consistent results, right? So it's less about the entries and more about the direction of the market, right? You can have a sloppy entry and your trade could be in drawdown for a day, 2 days, 3 days, and then still go in your direction, right? If you know how to place your stop loss properly, if you're trading on the proper time frame, if you're looking at the market structure from the higher time frames, right? A lot of people are trading the 1 minute time frame, 5 minutes time frame, 15-minute time frame, placing their stops on these time frames based off of all these order blocks, breakout blocks, whatever it is, right? And I'm not trying to say that all these don't work as an entry pattern, or you can get entries using smart money strategies. But in my opinion, there's certain ways you need to approach trading, right? There's certain ways you need to approach trading. You need to be able to look at the market from a long-term view, right? And let me just quickly break down what I'm trying to explain, right? So for this year, we have a lot of people will be doing the 78 or 79% retracements, break of structure, all of those things, right? To get another break of structure, you're expecting price to pull back and give you another entry. You want that very tight stop loss. Why would you be chasing the market with a tight stop loss? And the thing is, a lot of these people, if you go back and look through your trades, you will see that you get stopped out a lot of the times. What happens to these people is their trades look like this, right? Your trades will end up, let me quickly delete these entries just so you can see what I'm trying to show, right? So a lot of people will be trying to get entries when price comes to retest here and when price comes to retest here. But many of the times, what ends up happening is, this is what ends up happening, right? Price will sweep the stops and push down, right? Same thing here. Price will sweep the stop, maybe even this one too, right? And push down. Now, this is on the 15-minute time frame, right? They're expecting price to come back to this. And the funny thing is, you can get a little rejection, right? Price will give you a little push in your direction and then push up, right? In the opposite direction. Same thing here. You might get a little bit of profit in your direction, and then price will basically run through your stop and then go back in the direction which you predicted. And what people end up doing, they'll keep on chasing, they'll keep on looking for other entries, keep getting stopped out, and price will end up going that direction. Why? you're trading the markets very aggressively, right? And these markets work with liquidity, right? And liquidity just means getting rid of impatient buyers or impatient sellers, right? In order for the market to generate enough liquidity to go in that direction. Now, whenever you're trading with this idea, right, what I feel is you're being very impatient and you're approaching the market from a standpoint of instant gratification, right? And what I mean by instant gratification is you want the results to be immediate, right? So this is why a lot of people have that approach to the markets where it's like, okay, let me get in here with a 10 pip stop, and it's just going to go into profit, and they see their trades, it reacts from that level, boom, is in profit. But what they don't realize is it's just moved 10 pips from your entry or 20 pips. That doesn't mean you've gotten the direction of the trade right. It's just a reaction. So it's good for scaling in. I think the smart money strategies are good for scaling in, right? You can say that they are good for scaling into your trades. And if you don't know what I mean by scaling into your trades, right, we're just going to look at exhibit B, right? Using the ideology that I've given you here. So let's say this high, right? Let's say this high is the same as this high. Let's say it's the same as this high, right? But this high is the same as this high, right? And then on the higher time frame, let's say we're on the 4-hour time frame, right? And we have our entry here, and we notice that on the daily, we actually have a high here, where if price runs above this high, then we can consider the trend to be bullish, right? So we place our stops above this high, not this high, right? Now, we also anticipate that if price, let me extend this a bit, right? We also expect that if price comes into this level, just like what people are trying to do here, we know that people are going to sell, right? So what this could do is, if I have my entry somewhere around here, let me say I'm able to get my entry after price wishes down, I'm able to get my entry here. I put my stops here. I have about a 200 pip stop loss, right? I have a 200 pip stop loss, or a 150 pip stop loss, whatever the case may be, right? I have my entry here. And when price, let me pull this up a little bit more, just to get that, yeah. So what happens is when price pulls back to this level, which is here. So if I want to put one lot on this trade, right? If I want to put one lot on this trade, I could end up putting 0.25 here, putting another 0.25 here, or 0.5 here, another 0.5 here, just knowing that this is going to give a better entry. But when I put my second entry here, 0.5 lots, I still have my stops above here. So if I was to put one lot, and let's say I have a 200 pip stop loss, right? And I go with the first entry, 0.5. So I've risk is $500 on this entry, or sorry, $1,000 on this entry. And because I've been able to put in my second order here, what I've effectively done is I've been able to reduce my risk, right? I've been able to reduce my risk. So instead of risking $2,000, what I'll have as my total risk could be about, let's say, $1,500 or $1,700, right? So you can use this as a scaling method, right? In order to divide your entries. When you're trading on the higher time frames, or when I'm trading on the higher time frames rather, I notice that it's very easy, or it's very common for my trades to be in drawdown. So what does that tell me? That means, okay, I can actually go about my trades by splitting up my orders, right? I can split up my orders instead of just having one order that's going to be in drawdown. I can split up my orders, right? And whenever my trade is coming into drawdown, I can add more positions, right? So I would divide my initial order, and when my trade is in drawdown, I can add more positions. So that's one approach you can use from your knowledge of smart money, right? That's one approach you can use from your knowledge of smart money. But thinking that this is the way to go about it, and the reason why people go about this is you want to get that 1 to 10, 1 to 9, 1 to this, 1 to that, 1 to that, and it's fine. It's fine. You understand? If it works for you, if you are consistent with this style of trading, it's fine. But this is a more patient approach to trading, right? And that's something I've discovered is more patient. It gives you more time to analyze your trade. Even whilst you're in the trade, you can keep on analyzing and seeing, okay, is the direction right? Has your directional bias changed? Has anything changed structurally? Is there something else? It gives you more time to analyze your trades and look for something that you would have missed out on. While here, it's basically 15 minutes, you're stopped out. You don't even have enough time to look over the charts or go over the charts. You're just carried away by the sniper entry, right? Whereas with this kind of entry, you have the time to keep on analyzing your trade, seeing if there's anything you might have missed, if there's anything that can switch your bias from bearish to bullish, right? So you can switch your trade ideas because you have bought yourself time, right? This is a more patient approach to trading. And a lot of people that are trading smart money, they want to get like this 1 to 10, 1 to 7, 1 to 15, and all of that. But with these entries, you could be getting 1 to 2, 1 to 1.5, right? As long as it's above a 1 to 1, is a good trade. A lot of people don't believe that. A lot of people think you need this 1 to 3 or whatever. But what you actually need is a good strike rate. If you have a win rate of 60%, right? And you're doing 1 to 1.5 or 1 to 2, right? If you win 6 trades, you've done an average of, let's say, 12%, right? And you lose 4, that's 12 minus 4, right? You're good. Whilst with these trades, you have a strike rate of 20% at best, 30%, because a lot of people are not even good at trading this way, right?
It's 14
you have
hours.
a 20%, 30%, 40% strike rate, right? You're doing this so-called 1 to 3s. It's not even up to a 40% strike rate. I believe it's like a 20% strike rate, because when you're trading those 1 minute time frames, a lot of people tend to overtrade. Now, if this strategy works for you, if you've been consistent with it, that's fine. Okay. For me, I tried trading ICT and all of that. It didn't work for me, right? It didn't work for me. I understand the concept, right? I still use it in some ways till this day, right? Like I said, I could use it for a scaling entry, right? I could use it as a means of scaling in, but I do not place my stops the same way, or I don't use those tight stop approach. I have a more lenient, relaxed way of trading, and I like trading more on the long term, looking at the daily time frame, the weekly time frame, the monthly time frame, right? People think having a 200 pip stop loss is bad or something like that, but it's very, very, very reasonable, right? If you're trading the higher time frames and you're trading higher time frame structure and you're trading with higher time frame highs and lows, definitely you're not going to get a 30 pip stop loss or a 50 pip stop loss, right? There are times where the market moves in your favor, break structure, then you can adjust stops, right? So in a situation like this, let's say price does this, then pulls back, right? Pulls back, then makes a new low, right? Now I would adjust my stops to these highs, right? So I'll go from having a 200 pip stop loss to having a 40 pip stop loss, right? It's very simple. Or let me make it more let me make it more reasonable. So let's do it from here. And let's say we get a push up and then a push down, right? Now we can move our stops, right? Now we can move our stops to this high, put our stops above this high, and wait for the trade to complete. So this is how you can actually go about this rather than predicting that the high is going to be here. Let the market guide you, right? Let the market guide you. It's better to follow the market, follow the trend, than to predict where you feel is going to reverse from, right? You're trying to get these sniper entries and get this crazy risk to rewards, while you can be very, very conservative in your approach, buy yourself time to keep on looking at your trades and keep on asking questions, right? Keep on trying to fix things if you notice anything that you might have missed, right? That's one thing that's also hard to do as a trader. And a lot of people don't do it when they're trading, right? They don't get to ask themselves if their entries are actually correct or if there's anything they've missed, right? That's also part of trading, because one thing you want to do is you want to be able to cut your losses early, right? If you notice that there's something you've done wrong or there's something you've missed, right? You can now decide as a trader, okay, do I cut this trade in this loss and switch my bias, or do I hold this trade, right? And the less you hold your losses, the better for you as a trader, right? So a lot of people don't even get to experience that part or develop that part of themselves, right? Because they have very little time to think. You're on the 1 minute time frame, everything is happening so fast. You're taking 5 trades in a day, 3 trades in a day, you're over trading, right? So it's only a matter of time before you run out of capital, because it's very, very likely that you'll be emotionally unbalanced when you're trading this way, right? So if you're trading this way and it works for you, then fine, right? That's if you've proven to yourself that you've been consistent over a long period of time. You have your data, you have journaled all your trades for a long period of time, and you have data to support the fact that, yes, this is a profitable way for you to trade, then that's fine. But if you've been trying this way and it hasn't been working, you might find it beneficial to try to adjust and zoom out, start trading on the higher time frames rather. Look at the monthly time frames, look at the weekly time frames, look at the daily, look at the 4 hour. Make a judgment on where price is going to go. Look at the higher time frame levels of structure. Realize where you can have your stops and your entries, right? You can have a bad entry. All you know is, even if you have a bad entry, you can still say, okay, even if this trade is going to go in drawdown, it's going to come into this level, it shouldn't go below this level. If it goes below this level, then my bias should change, right? And you can just adjust your risk parameters as well, right? You can adjust your risk parameters as well. There's nothing wrong in that, but a lot of people think it's wrong. A lot of people are so obsessed with sniper entries. Who cares about sniper entries? You should be focused on winning more trades than sniper entries, right? And a lot of people get confused when they see their trade running in drawdown. They can't stand it. I believe something that helps you as a trader is to have more of your trades run in drawdown. Yes, more of your trades should start in drawdown. Whenever I see most of my trades that go immediately into profit, I feel they're going to reverse. I always have this feeling that, okay, it might go back into loss. But whenever I have those trades that are in drawdown, I am more comfortable. It's weird. I'm more comfortable when I have trades running in drawdown, because now I have more time to look at the market and be like, okay, is there something we missed? But whenever the trade is in profit, you might get overwhelmed and you're like, okay, it's going to go to by the time I close this and come back, it would have hit TP. By the time you close and you come back, it has blown your account, right? So you need to be trading from a very, very humble state, right? You need to be able to reevaluate your decisions time and time and time and time again, right? You need to be able to reevaluate your decisions time and time and time again. And you need to be trading from a calm state. So you need to be able to look at the market and have time to make decisions. Trading is all about decision making. You do not want to rush your decisions. You want to be able to take your time. That's the whole point of trading these higher time frames. It's not just about being safer or having more. It's not just about having huge RRs and all of that. It's more about having time to think, right? So this is just my own opinion. This is how I've been viewing the markets lately, and it has been working for me, right? It has worked for me very, very well. There's still people that are good at day trading. Another thing I don't like about day trading is the markets cannot be volatile every day. And except you are good at studying market volatility and you know the days to trade and the days not to trade, the days with high volume and the days with low volume, then you can have a shot as a day trader. Or if you're just day trading every day, right, without being able to measure volatility in the market, you're not doing yourself any favors as well, right? So a lot of people are going off of this day trading mindset without knowing the days that are volatile, without being able to study market volatility. I don't know shit about when the market is volatile and when the market is not volatile. So I prefer trading on the higher time frames because I can be in drawdown until the market picks up volatility and goes in my direction if I'm on the right side of the market, right? So that's my own approach to trading. That's my own approach to trading, right? So I just decided to share this with you guys, that smart money trading, trading ICT and all of that can be actually what's slowing you down, right? You might have a good understanding of how the market works, but just because you're trading smart money concepts, you are still not able to be profitable consistently. So you might want to look at it from that perspective, right? A lot of people are so obsessed with the perfect entries, right? You cannot be obsessed with perfect entries. You should be obsessed with calling the direction of the market correctly. If you can call the daily time frame directly, there is no doubt you'll be able to call 500 pip moves, 800 pip moves, right? So if you're able to call the direction of the market on these higher time frames, then you can trade consistently and be profitable consistently. You just need patience. A lot of people are not patient. How can you be a trader without having patience, right? It doesn't make any sense. This, for me, is a more impatient way of trading. It's more focused on instant gratification. This style of trading is more delayed gratification, right? It's more of delayed gratification. This has less greed attached to it. This has more greed attached to it. We know that the market works on fear and greed. When you're trading like this, it's a sign of greed, right? You might want to reevaluate yourself and check yourself, right? If you're falling for this, then you might be one of those people who's susceptible to greed. I don't know the word, susceptible. My English is terrible, but yeah, to greed, right? You might be prone to greed. You might be a greedy person. The greed approach works on you, or the greed approach has been sold to you, and that's why you're forcing this. This is less sexy, it's less enticing, but it works, right? It works, and it works very well. It's very, very uncommon for the market to be swinging on the daily time frame, taking liquidity here, but it's much, much easier for the market to be taking liquidity and grabbing liquidity up and down on the lower time frames, right? The market can easily sweep here on the 1 minute, 5 minutes, but it's very difficult for the market to just be sweeping liquidity on the daily time frame, on the weekly time frame, on the monthly time frame. It's basically very, very hard because the market can't just be doing 1,000 pip moves every day, but the market can do 30 pip moves, 20 pip moves every day, right? So you might want to reevaluate your standpoint and your approach to trading, right? That could help you a lot. That could help you a whole lot, right? So I hope this video has been able to bring value to you. If you found some value, if this struck a nerve as well, leave a comment. If you found some value, leave a comment, share, like, subscribe, and I'll see you guys in the next one. Thank you.